Lindsay will do that.
Okay. Well, good morning. It's June 2nd, right? And we're day 2 of the board meeting of the Board of Investments. Call the meeting to order, and Lindsay, can we get you to do a roll call?
Absolutely. Good morning, everybody. Carl England,
Here.
Jack Prothero,
Here.
Jeff Greenfield,
Here.
Terry Cohey,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Representative Walsh,
Here.
and Senator Osmondson.
Here.
All right. Everyone is here. We do have a quorum.
All right. Well, now that our 2 legislative liaisons are here and present, welcome to you both. And I thought maybe we'd just take a minute here and introduce ourselves to you. I'm Carl England. I'm an attorney from Missoula. The statute says that for quasi-judicial boards, there has to be a lawyer. So I guess that's me.
That's you.
And I've been on the board since, I had to look it up. I've been on the board since I was appointed by Governor Schweitzer in 2007. Jack?
Hey, I'm Jack Prothero. I'm from Great Falls. I'm a retired banker and telling Carl the bankers are taking over the world now, at least at Board of Investments.
Boy, we're in trouble.
I've been on this board a long time. This is my 17th year.
Senator Ryan Osmondson. I have been in the legislature since 2011. I have always served on appropriations in the House and then Senate Finance and Claims in the Senate. I currently chair Senate Finance and Claims, and I also chair Legislative Finance Committee in the interim. I farm and ranch in Buffalo, Montana. If anybody knows where that is, southwest of Lewistown. Small, quaint. It's more of a community than a town, really. But we have 10 kids, so we have all kinds of help on the ranch and farm. They're great kids. They do a lot of work on it, and we homeschool. So when we're in the middle of nowhere, COVID really didn't have much of an effect on us. Kids asked, "What's a quarantine?" I said, "It's what we're already doing."
That's how you live.
Right, fine. So anyway, just glad to be here. Thank you for the opportunity to learn from all of you. I appreciate it. So.
I'm Diane Fladmo. I'm the Director of Public Policy for Montana Federation of Public Employees. I'm the labor representative, or one of the labor representatives here. And I've been on the board. I was appointed by Governor Bullock and then confirmed in 2019. So I have a little while left. I'm one of the newer members. Still much to learn, but I really enjoy the board, and welcome to both of you.
John Putnam, I'm the Chief Investment Officer for the last year or so. Got appointed CIO about a month before COVID kicked off and promptly lost $2 billion or so, but we recovered more.
We don't hold it against you.
No. Things happen, right?
Sorry, things happen.
Things go up, go down. I've been with the board for a little over 16 years and have been in a variety of roles with the board throughout that time. And welcome.
I'm Jeff Greenfield, longtime teacher, 27 years, retired. I'm a TRS board liaison, appointee, member, whatever term is the appropriate term. I've been on since maybe 2016, and I've had 2 different stints with the teachers retirement system. And learned a lot in the few years that I've been on here, so you guys are in for a treat. And welcome.
Jeff Meredith, banker from Kalispell, work for Glacier Bank, new member, so just started in January, so just getting my feet wet, but enjoying it so far.
I'm Maggie Peterson. I'm retired from Montana Tech after 29 and a half years there. We have a family ranch, and we beat you because my husband has 13 kids in his family, 11 girls and 2 boys. We still run. And I've been on the Impera boards I think this is my second go around on Impera and my second time I was reconfirmed on this board. So I'm having a ball as being a retiree and a grandma.
I'm Terry Cohe. I'm here in Helena. I'm a retired financial consultant for DA Davidson. I worked in state government for 20 years. I was the legislative fiscal analyst and chief of staff to Governor Schwinden. And I've served 2 times on the board, and I think I'm on my 13th year, I think. Yeah, and I've got 2 more years to go. And then I think I'm done.
I don't know.
I'm Mark Berry. I'm also from Helena, retired CFO from Montana State Fund. I retired in 2019. I was appointed by Governor Gianforte, as Jeff was in January. And excited to be here serving on the board.
I'm Bruce Nelson, native of Fort Benton, where our family farm is. Now live in Bozeman. I'm a retired state bureaucrat, worked for Governor Judge and for Governor Schweitzer, and federal bureaucrat, worked for President Clinton and President Obama with Farm Service Agency, and semi-retired farmer. I was appointed in 2019 by Governor Bullock, and welcome. Glad you're here. Look forward to working with you.
Well, I'm Ken Walsh, freshman legislator. Just getting acquainted with the whole Helena scene. And so learned a great deal. My real life, I was a banker for 33 years, small independent bank in the Ruby Valley, Twin Bridges and Sheridan. Did that, raised on the family ranch south of Twin Bridges. Now I'm a rancher and a legislator and various other things. So look forward. I listened to as much as I could yesterday. Those other obligations got in the way. But look forward to learning. In the legislature, I served on the state administration committee, and big discussion there was pensions. And so you guys handle the money. And for those that have those vested interest, I'm sure they're very concerned about that. And so it's a cooperative effort to get good returns and get those solvent again. So look forward to learning a lot, and already have, and sometimes it's hard to teach an old dog new tricks, but we're learning. In the banking deal, we did as a small-time banker, we did everything. So our investment portfolio was a lot less complicated than yours is. Fannie, Freddie, those type of things. And, you just use those monies for liquidity and filled in the gaps. But we always wanted to make more loans than we did buy investments. And so not, and the regulators told us what we could buy and what we couldn't. And so that was pretty easy decisions. So thank you. Look forward to it.
I'm Dan Villa. I'm the board's executive director. I'm almost at 17 years in state government. Been here since 2018.
All right. Okay, well, thank you. And again, welcome. And any public comments, matters within the board's jurisdiction? If not, let's do I think we're at tab 8 and our real estate asset class review for our new members. There's a little history here. We've had, how many years, Jack and Terry, worth the debate about how to do board education. Years.
17 years.
17. And eventually came to the decision that the way to do board education was to basically on a 2-year cycle to just sort of have people educate us about what we do, why we do it, how we do it, what we don't do, that kind of thing, rather than send a bunch of people to conferences and things like that. And so yesterday we heard some of that in terms of the fixed income, and now today we're going to get some on real estate. And Ethan will explain it all to you, and by the end you will be able to run the whole portfolio on your own. How's that, Ethan?
Wonderful setup. Thanks, Carl.
Yeah, good. No expectations?
And if there's any acronyms that you don't know what they mean, just ask, because they're in the back of our board book. That's the first thing I did the whole year is ask, what does this mean? What does this mean? What does this mean? And they're very good. Ethan's very good at explaining what they mean.
You're on, Ethan.
Well, good morning, Mr. Chairman, members of the board. To our new representatives, just briefly, I'll follow suit here. My name's Ethan Hurley. I'm the Director of Real Estate and Real Assets. This October, I will have been with the board for 10 years. I originally started as the portfolio manager of alternatives, running, in addition to real estate and real assets, private equity and credit and so forth, but am now exclusively focused on real assets and real estate. Moved up here from Phoenix, Arizona 10 years ago with my wife and 2 kiddos. My kiddos are now 10 and 12, and we haven't looked back. We love it here, love working at the board. And so welcome. Please ask questions. That's where all the meaningful discussion happens. So with that, let's dive into some real estate talk here. So if we could turn to page 3, that'd be great. We'll discuss the role, the allocation, and the constraints. So we're in real estate essentially for diversification. We seek to diversify within the real estate asset class by vintage year, property types, geographies, and we're looking for long-term capital gains and current income. Our allocation to real estate is 5 to 13%. It's a range for a reason. We do have a midpoint, but we invest based on the opportunity, not based on trying to hit an allocation. That makes sense to me because if the opportunity isn't there, it doesn't make any sense to invest. So it's very opportunistic, it's very bottoms up, and we have a range for a reason. On page 3, you'll see the various constraints, the investment policy constraints, the strategic constraints, the leverage constraints. Happy to address any questions. Otherwise, we can keep rolling through the presentation. Hearing none, let's move to page 4. So here's our opportunity set in our investment approach. And as a reminder, our asset class contemplates all 4 quadrants: public, private, debt, and equity. And it just so happens that within the real estate asset class, we actually have exposure in all 4 quadrants. Any questions here? Very good. Let's move to page 5. This is kind of a cool slide. This touches on our approach to private, specifically private real estate investing, and specifically private debt and private equity. And the key takeaway here is while all these pictures are the same, the risk that you can take investing in this property can be very different depending on leverage, occupancy, capital budgets, repositioning plans, and that is the case across the equity spectrum or the private debt spectrum. Just as an example, on the far right, non-core opportunistic, this looks like a Class A building in a Tier 1 market, but it could be 100% vacant. And the manager that bought it might be wanting to put 70% debt on it. So that would make it a very risky investment They have to take up serious leasing risk, lease it up, grow net operating income. They're putting a pretty heavy debt load on it. So they're banking on their ability to lease it up and grow net income to obviously service that debt. So a very different risk profile than if the manager acquired this building, and we're looking at the far left-hand side core, where this is a Class A property in a Tier 1 market, and it's 95% occupied. They put maybe 0 to 30% leverage on it. It's got credit tenants, and it's very low risk. It's more of an income play. So just note, similar, exact same asset could have very different risk profile depending on the status of the underlying property and the strategy of the investor or the GP or investment manager. Anything I can address on this slide before moving on?
My favorite euphemism, bad real estate is opportunistic.
Ain't that the truth? All right, well, let's move to slide 6. So here we address the various types of fund managers that we invest in within the real estate asset class. We invest in private equity allocators, who are essentially folks that raise a pool of capital to then allocate to property types with the help of local joint venture operating partners that are spread across the U.S. These allocators will typically account for 95% of the capital to acquire property. The joint venture partners, local operating partners on the ground, will contribute anywhere from 5 to 10 to 15%. But they will have the day-to-day operating responsibilities for the actual property. They're also very handy when it comes to sourcing deals. They'll often bring deals to these private equity allocators. Very different from the private equity operators, which are vertically integrated organizations. They have all the responsibilities of sourcing, financing, acquiring, construction and development, property and asset management. So very different models. One is more of a capital provider. Certainly they control all major budget and leasing decisions. They control the property, and sort of put together the property and asset management plan, but the local operators have the day-to-day operations versus the operators who you invest directly with, who have responsibilities across the board. We have private debt managers, Walton Street Capital. For example, they originate first lien mortgages. So just think of, the mortgage you originated with your bank to go put debt on your house. These guys will loan money to the private equity allocators and the private equity operators to go buy commercial real estate throughout the US and the world. We have our public REIT managers. Center Square is our single public REIT manager there. We have a separate account with them, and they manage a diversified separate account mandate that, targets beating the MSCI REIT index. Then we have our public debt managers, Fidelity Real Estate High Income. This is our singular public debt manager. They manage a diversified, 1940 Act registered mutual fund that invests in high yield CMBS here in the good old US of A. Any questions about the different types of managers we invest in?
On the public debt managers, that's not a separate account?
No, that is in fact a 1940 Act registered mutual fund investment. So we are commingled with a number of other investors in that vehicle. I believe assets under management in that particular fund is just shy of $2 billion, of which we represent, I believe, 160 plus million.
Carl?
Yeah.
Ethan, do you have kind of a guesstimate percentage-wise how we're invested in each of these different types? Was it 40% one type, 10% another type?
Yeah, sure. So if I went from the top of my head, private equity, real estate, I believe we're about 70%. Public equity, give me just a second, I'll nail it here. Public equity, we're at 14.2%. Public debt, we're at 11%. Private debt, we're at almost 5%. That's as of 12/31.
Thank you.
Absolutely. Any other questions here?
And is that the allocation? I mean, is that sort of the, are you where you want to be with that, or are you moving in one direction?
Good question. I'm not exactly where I want to be. Ultimately, I'd like to see our public real estate exposure grow and our core exposure continue to shrink. Core is part of our private equity. So through time, I would expect that our public equity exposure will grow, private equity exposure will reduce. That will also reduce as a function of our debt exposure continuing to grow. Likely not so much on the public debt side, but certainly on the private debt side. We do have a number, two outstanding commitments with Walton Street and another high conviction debt manager, Angela Gordon, that are, arguably 30 to 50% drawn down. Those are $100 million commitments each. And so those will grow through time. We'll continue to serially invest with those two managers, assuming, all things being equal, things stay the same, performance continues, there's not a blow up organizationally, et cetera. But yeah, I'd like to see our private debt and our public real estate exposure grow, our core exposure shrink. And as a function of that, our private equity exposure will ultimately shrink. Did that answer your question, Carl?
Does, but so the next question is why?
Why? So I'll address specifically why do I want to grow public equity. So if you look at the public REITs relative to, say, core private real estate, which is the best proxy, that's the closest to an apples to apples comparison, notwithstanding the fact that one's private and one's public. If you look at the long-term track record of public REITs, they outperform private core real estate. That's a function of two things, lower fees and a little bit higher leverage. You get volatility with that, but you get the same types of credit, you get the same types of properties, locations. You also get access to different sectors, particularly data centers, cell phone towers, et cetera, that are growing dramatically that you can't readily access through the private markets. There are private market strategies that invest in these particular types of sectors. I've been looking for a data fund manager for a number of years. Emily and I looked at a few, we passed. They were just startup firms. There was some partnerships, startup risk. Haven't found the right operator there. I'm looking at a potential co-investment in the data center space for future reference. But that's why I want to grow public equity and reduce core equity. As it relates to why grow debt, I just think a couple things there. It's a risk mitigator. It's, arguably, if you look at the capital structure, debt is less risky than equity. So a little more debt will reduce the overall risk of the portfolio. And we also gain contractual current income.
Thank you.
Sure.
Ethan, what is your expected rate on private equity? What is a good rate on that?
Rate of return? Yeah, so I believe that on a blended basis across the various private equity strategies, if we can achieve a 9%, 8-9% rate of return through time, that's pretty much what you should expect. That is with prudent diversification and good manager diversification, good property type diversification. We are a North American centric portfolio that is very deliberate. But real estate is not a high flyer in my opinion. People who say they're targeting 12 plus net %, they better be allocating the preponderance, the vast majority of their private equity real estate portfolio, their real estate portfolio, to very opportunistic real estate strategies. And while I could make an argument for that, I don't think it's the prudent choice. Was that helpful?
It does, thank you.
Very good.
Yeah, sure.
Very opportunistic. Triple opportunistic.
If there's no other questions, thank you. We're on to slide 7. So sources and drivers of returns. This is pretty straightforward. Your two sources of return are appreciation or depreciation and income. The drivers of that are listed on the right. It's not an exhaustive list, but it's pretty comprehensive. I'm happy to address any specific questions or any specific bullet point there if it's not clear.
Just a quick question. Have we seen commercial real estate vacancies decline? Is that an expectation going forward, or is that just not that significant?
So the answer is it's mixed, and we can talk about it as much as we'd like here today. Office has certainly been gravely impacted through the pandemic. It's coming back a lot more than folks had anticipated. Certainly anecdotally 6-8 months ago, it was the death knell of office, given work from home and technology adoption and so forth. But it's actually coming back much stronger than folks had anticipated. I think the current chatter on the street is somewhere between 10 to 20% of the office space on a go-forward basis will be either vacated permanently, reconfigured to an alternative, higher and better use, et cetera. But, the talk of 40 to 60%, office occupancy going away forever, that is no longer the case. Certainly hotels have been crushed. That's a function of, both leisure and business travel. I think that will ultimately come back. It's currently very, very depressed. Occupancies, I think, are still bumping around the 30-40% range. But as we continue to move through the pandemic and return to normal, I think ultimately hotels will come back. Maybe not as vibrantly as they had in the past, but certainly not dead in the water. Industrial never missed a beat. Self-storage never missed a beat. Multifamily occupancy certainly came down, but now we're back up at sort of pre-pandemic values and occupancies. So I guess all I'm trying to say is it's very mixed, depending on the property type and depending on the location. But generally speaking, commercial real estate performed exceptionally well through the crisis, through the pandemic, and is on very stable ground currently.
Thank you.
Certainly. Slide 8, benefits. We touched on this a little bit earlier. It's a return enhancer, it's a diversifier, there's contractual income. Depending on the property type and the lease structure, there's an inflation hedge there. There's active management, so the ability to influence performance. Happy to address any of these specific bullet points to the extent there are questions. Risks, they are here. We're in the business of taking risk. There's no return without taking risk. And so I've laid some out here for you to consider and know about. Happy to address any or all of them.
Oh, I have a question. So, yesterday the fixed folks were here and they talked about how they evaluate their selections. Do you have a matrix or something to assess the risk of a deal and who looks at that? And is it a committee that's looking at these sorts of things to determine your recommendations, or how's that done, Ethan?
Yeah, so that really, Mark, addresses our overall process and how we address that. So maybe just to keep it super high level first, and then we can definitely dive in, but the real main way to address and assess well, to answer your question directly, no, we don't have a matrix. Do we look at these risks and assess them? The answer is yes. And that is primarily assessed through looking at their performance track record and their ability to generate returns on a sustainable and repeatable basis. And if they're able to do that consistently without massive volatility, that says to me that they are very good at assessing all of these risks before they make an investment. If you see massive volatility from one property to the next in the same vintage year, or they lose properties to the lender because they either over-levered, they weren't able to grow net operating income, they weren't able to put the right property management in place, weren't able to lease up at market rates with inflation adjustment throughout the term of the lease, they weren't able to put the right leverage on, be it fixed or floating, or, they didn't match the asset to the liability properly, and they end up giving the keys away. Those are things that come out in our due diligence and underwriting. There's a very comprehensive and robust data sheet that we provide to the GPs that we ask them to fill out a number of metrics. It's extremely robust, which we're then able to assess, are they, where do they acquire the building, at what price, at what occupancy, at what debt level, where did they, exit the property, at what price, at what occupancy, at what debt level, at what income level did they acquire the property, at what income level did they exit the opportunity. So that gives us an ability to understand whether they're levering up or delevering, if they're able to actually grow occupancy or not, are they able to actually grow income or not. And those are very key operating metrics at the property level that are, frankly, I'm razor focused on. And to the extent all of those point to yes, as far as, they're growing occupancy, they're growing net operating income, they're not over levering the property through time. They haven't, lost properties to the bank. There's no volatility in the track record. Sure, nobody bats 1,000, but you like to see consistency. If I can get comfortable with all those metrics, then I can understand that our managers, who I'm assessing primarily, are able to assess these various risks and do it successfully. Was that helpful, Mark?
Ethan, tell me what's meant by counterparty risk.
So you can think about, let's just take the example of a debt manager who is originating a loan for an equity capital partner who's going to buy the opportunity, the property, and then subsequently operate it. So the debt manager is taking counterparty risk in the form of the equity whom they're sponsoring, whom they're sort of entering the deal with. You've got the debt manager who's giving the equity provider a loan, and that in and of itself is an affiliated, there's a transaction there, and the equity is the counterparty to the debt. And sometimes, the equity doesn't perform. They may not be able to lease up the property. They may seek to overlever the property. They may not be able to grow net operating income to ultimately service the debt. And as such, they default, and the debt manager is now owning the property because the equity failed. And so they've taken it onto their balance sheet. Maybe it's a bank that financed it. And so now they have real estate owned on their own balance sheet. They're not a natural owner of the real estate. They don't know how to operate the real estate. It's not their competitive advantage to own and operate real estate. So they need to underwrite that counterparty very well and very carefully to make sure that, they have the expertise to operate the income and perform on that loan. Or if they don't, perhaps they have strong enough balance sheet to then make an equity cure and, pay down the debt such that whatever they're doing at the property level comes in line and they're now able to service the debt and, survive another day. Does that make sense, Carl?
It does.
Do you want to talk about legal risk, Carl?
Do I?
That comes in when they hire the attorney.
That's when we send Ethan out to make sure no one's slipping and falling.
Any more questions or shall we move on?
Go ahead.
Please.
All right. Here we are on slide 10, pacing. So pacing is it's a commitment plan of when and how much to invest in real estate to reach or maintain a desired target or allocation. There's a lot of things to consider here, all of which I've listed out here. But from my perspective, the key takeaways are this is very inexact exercise. And the only real controllable inputs and metrics are how much we commit on any given year. We have a strategic asset allocation and we have an expected rate of return, but it's just expected. So we really don't know what the portfolio valuation and what the annual growth rate of the overall portfolio is going to do in any given year. We really don't know how quickly capital is going to be drawn down. We don't know how quickly it's going to be distributed. Those are all sort of forecasts based on historical behavior, and they're completely unknown. Pacing really serves more as a sort of a guideline. It provides guideposts. The last pacing study we did, I believe was in August of 2020. We talked about reaching the 9% allocation. Well, guess what? If we turn to the next page, you can in that pacing study, sort of indicated that we should be investing or committing approximately $200 million a year. Well, back to one of my prior comments, you shouldn't commit just to commit. You shouldn't invest just to invest. It's really based on the opportunity set and your bottoms-up analysis. And so based on that philosophy, if you look at slide 11, our commitments are all over the board. And guess what? We did hit 9% just earlier this year. But it wasn't based on $200 million of committing every year. We have rebalanced the portfolio a number of times, adding to public REITs, adding to our public debt because we saw opportunity there in cheap valuations. And so again, really, I wouldn't spend a whole lot of mind share thinking about this other than it's very inexact. It's subject to a lot of variables that are out of our control. And in addition, I guess, just based on the commitment study, I think the last commitment study talked about us hitting $14 billion as a fund by 2024, 2025. And I believe we did that earlier this year. So just, it's just inexact. And I'm happy to address any specific questions or try to flesh out further details. Sorry, go ahead.
Could I ask about the market right now? So are you seeing a lot of deals in 2021? Do you think we're going to see that grow the rest of the year? Or, what kind of environment for deals are you seeing?
So when I think about deals, I think about, underwriting the funds that we invest in. And from my perspective, I'm not seeing a whole lot of change, to be honest, Jack. I'm as busy as I've ever been. We just approved another $50 million commitment just last Friday. What I'm definitely not seeing is sort of distressed. There are some deals in funds that I'm looking at or have seen that are sort of, quote, distressed or special opportunities. From my perspective, those are all marketing terms. If you talk to any one of our managers, they're fully capable of sourcing mispriced deals, sourcing distressed deals, talking to banks, trying to, acquire loans and take over properties at discounted values. Certainly fundraising has dropped, was down last year, is down this year. But, from my perspective, we're really focused on our high conviction GPs, Jack, and they are back in the market with deals. The portfolio is really in a position where, at least from my perspective, I'm not seeking out a whole lot of new stuff. The construction of the portfolio feels really good. We have the managers we want. There's a number of managers that are sort of in liquidation and de-emphasis mode, and we're not re-upping with them. But those high conviction managers that we have in various property types and so forth, that's really where I'm spending my time, understanding the portfolio more, looking at their new funds that come out. But overall, to your question, I'm not seeing any deceleration in the amount of funds that are coming into my inbox, and I'm having to review or process through as a result of the pandemic, for example.
Thank you.
Sure.
So Ethan, I want to get back to the pacing thing for a minute, because it seems to me that we periodically do these pacing studies, right?
Right.
And then it seems to me that what you're saying is that they're interesting, but they don't really help very much. And so, are they worth doing, or do we do them because it's best practices to do them and we do them anyway, or is it just, or are you saying that they're a tool, but we can't rely completely on them?
Carl, if I'm speaking freely, you basically nailed it from my perspective. It's a best practice. Everybody does it. I think there are certain plans that do them and abide by them. A lot of those plans will do that because they have perhaps a much narrower range, and they do invest to hit and maintain a target. But from my perspective, in my experience, we have never followed a pacing plan. We don't refer to the pacing plan as far as our annual commitments are concerned. It's very dependent upon a number of variables that are completely out of our control and completely unforecastable with any confidence interval. And so I guess that's all to say that it's something we do, but we do not utilize in our day-to-day, ever.
Carl, this is Jim from RBK. Could I make a comment about this point?
Well, yeah. You want to go first?
Let me
Let's hear from John first.
So, Ethan's right. The pacing study, you can't follow it exactly. All of these things are unknown. He's right. The last one we did says, we're going to invest 200 to get to our 9%. We're trying to write at our 9% right now. Ethan's out there finding deals, but I will say, he's focused on this asset class, right? Finding the best deals he can. I'm focused on what's the right mix for the overall portfolio. So we have a natural tension there of sometimes, he wants to do a deal or he wants to go bigger in a deal than maybe I'm comfortable with. I am paying attention to broadly, because you can't nail it down, but broadly, are we within range? Are we comfortable within that range? One of the really nice aspects I think that we've done more recently here is we have scaled up, as he was talking about, in public REITs and public debt. Now, that is a lot of what has gotten us to our current 9%, right on the midpoint, essentially in the range. But if things change and we have a sell-off and we're, further out of range, or, real estate looks highly valued versus equities that, tanked or something, it gives us a lot more ability to rebalance with stuff like that. Obviously, when we're in some of the private equity type funds, you're in, you know, and they're going to call capital. You can't do anything about that, but we can trade in and out of our public, you know, REIT manager, our public debt manager. So I agree with everything that Ethan said. Some of the stuff, when you're looking at commitments and you look at this commitment page, oftentimes we may be talking about deals and it may be, hey, you know, these guys are closing this fund in December. So it's going to be a, you know, 2020 deal, but really it's kind of a, you know, is it 20 or is it 2021? I mean, we're not going to get overly picky, and that's maybe why you see certain spikes here, but if hopefully over the long term, it's kind of smoothed out. You know, it's a little, you know, maybe it's a little like pension fund returns or something. There's a little smoothing you need to look at to be cognizant that it doesn't, you know, you can't control maybe every year, but you can modestly control, you know, what's going to happen over the long term and make sure that you're not going to dramatically overshoot. So as an example, for this particular year, we kind of had the discussion, okay, 300 million for real estate is pretty much our target of what we would invest. I kind of placed that a little bit more in the private equity type realm, because again, I can choose or not to, you know, add or subtract from the public manager. And it's, you know, more like 150 with real assets. So we do have soft targets there, I guess, if you will, that are guided by this process of looking at this. But I agree with everything Ethan said. It's a very inexact science and we have to apply some judgment to it over time.
Jim?
Yeah, thank you. I want to go back to something that Ethan said. He said that pacing studies are best practice. And the question that I would like to ask and answer is why are pacing studies best practice across all institutional funds? This board and this fund happen to benefit from a very competent and sober and reliable process and asset class officer. And as John referred to, a healthy tension between John looking at the total portfolio and Ethan looking at his asset class. But the history of institutional investing in privates is quite clear. And that is that there are many examples of funds that have wildly overcommitted to private investments, whether it's private equity, private real estate, and come to rue the day. And so that's why pacing studies, as inexact as they are best practice across all institutional investing. This board has been so fortunate as to not have to ever experience that. But as Becky will tell you as well, we've seen it multiple times. So pacing studies, as inexact as they are the only thing that's available to sort of keep track periodically of where you are on the commitment cycle and how it might affect your asset allocation. And it's one of the reasons why best practice is to do one every year, because kind of like when you're driving across eastern Montana and there's a crosswind blowing on the highway, but it's gusty. So sometimes it'll blow you toward the other lane and you have to make an adjustment back into your lane. Sometimes it'll blow the other way and it's going to push you off the road. You have to make a small adjustment. That's what pacing studies are all about. That, as John said, they're not deterministic. They don't tell you exactly what to do because, as Ethan said, the ground underneath you keeps moving. Those gusts keep blowing left and right, and you have to keep adjusting to them. But I can tell you from experience that there are lots of institutional funds that have not been disciplined from a pacing point of view, and they've created more risk for themselves than opportunity. I'll stop there. Thanks.
Thanks, Jim. And for new board members, we have RBK is our independent consultant, national independent consultant, provides the board both another set of eyes and ears and also, technical expertise that the staff relies on and works with. And we'll hear more from Jim and Becky and Mark from RBK a little later today. But and Jim has a tendency to use analogies. So, if you don't understand wind in eastern Montana, let me know.
I have driven across eastern Montana. I swear that's the truth.
Yeah, well, yeah, it never blows in Buffalo. I know that.
Just, maybe just to add, the RVK works directly for the board. So they are independent of staff. We work with them to come up with best practices and bounce ideas off of one another. But if there's ever an instance where RVK sees that we're really messing up, they report that to the board independent of staff. So it's a bit of a check on us.
Mr. Chair.
Yes.
Question for the board. So on the pacing study, RVK completes that pacing study?
Yes.
And then does board look at that pacing study?
Yes,
All right, thanks.
and it's fascinating. There's nothing like a long discussion of a pacing study.
Follow it up with foreign exchange and we're
Right.
good to go.
Some benchmarks.
Yeah.
Before Ethan goes on, I just want to say that I actually really appreciate the fact that you consider opportunistic and good, solid investments instead of just doing it because this study says so. So the combination, I'm really happy you do that.
All right, Ethan, I think we're back to you.
Okay.
Looks like we're back to you.
Great. Thanks for the comment, Jeff. Appreciate that, by the way. That means a lot. So let's move on to slide 13. And we'll dive into process here. So our process is pretty straightforward. It's repeatable and it's disciplined. And you can kind of see the circular flow chart here. We start at deal sourcing, we move to screening and diligence, the cabinet decision-making, meeting, legal review, and fund monitoring. And we'll break each one of those down one at a time, starting with deal sourcing. On page 14, you'll see all the various ways in which we source deals. Deal flow is our lifeblood. If we don't have deal flow, we've got nothing to invest in. I mean, that's the bottom line. So that's the approach. It's almost as important, the most important part of our process. Every piece is important and critically so, but without deal flow, we'd have nothing to invest in. And my personal philosophy is I'm just a bird dog. I look at everything. I talk to our limited partners. I talk to GPs. I read articles. And if something comes up in an article about somebody doing something interesting, I'll hop on the internet and pull up their website and look at their website. And then I'll cold call firms. We look at, we talk to consultants, placement agents. Like I said, periodicals. We use Preqin, which is an external database. Anything and everything I can get my hands on to source new deals, understand new deals, review new deals, I'm all over it. And that's what I tell everybody I work with. We need to really embrace deal flow and constantly source deals. It's part of my daily acumen. I'm reviewing anywhere from 1 to 8 deals a day, literally. It can be overwhelming at times, but it's very critical. So it all starts with deal sourcing. Any questions there? So on the next page, you can kind of see what we've done year to date through 2021 since 2016. Basically the takeaway here is we evaluate a lot of deals, but we have a very high bar as far as funds we actually commit to. So this is just a visual to give you a sense of what we do and the deal flow we see. Again, critical component of the overall process. Moving on to 16, we have street, please.
Could you kind of explain the deal flow and just what sort of triggers may, eliminate a fund along this path as you kind of move through, kind of examples of that?
Yeah, sure. So that's actually a great segue to page 16 here, which is our initial review. So what primarily drives is portfolio fit. So are we missing something in the portfolio that we want, that this fund represents? If that's not the case, that's a quick no. So for example, I have been fading and de-emphasizing hotels and office exposure for any number of years. That has been the case pre-pandemic. It's been going on in my sort of own investment philosophy for a while. Part of that is because there's smaller, tighter, narrower net operating income margins. Hotels and office are more highly correlated to the business cycle, so there's a lot more volatility there. You need to be more cycle aware and acutely focused than, say, multifamily, which is pretty steady Eddie, irrespective of downturns. So it starts with portfolio fit. But a key thing to think about there is just because we don't have it in the portfolio doesn't mean we need it. That is another sort of principle I bring to bear in my investment decision making and sort of sourcing acumen. So very key component, student housing. We don't have a whole lot of student housing. We have some exposure to the space through one of our allocators, but just because we don't have student housing doesn't mean we need to go build a significant student housing exposure in our portfolio. We have multifamily, and that's kind of like student housing. It's just with a bunch of students in it. But guess what? Multifamily assets that are located near universities, they also have a lot of students in them. So it's kind of that bit of analysis goes through how to evaluate screen funds. If moving on to the sort of the next derivative there, if there's a portfolio fit and it's something I'm really looking for, then the application comes down to things like track record, volatility of track record, various commercial or business economic terms associated with that fund. If for whatever reason they're charging an exuberant, management fee, or their profit sharing is, over and above what is institutionally accepted, that screens out funds pretty quickly too. So initial screen is portfolio fit. Secondary screen is, terms and track record at a very high level. After that, it gets a little bit more detailed.
Before you go on to the detail, Terry has a question.
Just a quick question. You said that you've been for several years trying to reduce office exposure. I note on page 30 that we're, as of the end of last year, we were 31% on office, and obviously hotel was less than 3. How high did we used to be on office then?
Terry, I would have to, that's a great question, and there's a lot of reasons for how high it is. My memory is not such that I know how high we were, let's call it a year ago or 2 years ago. My sense is we were at probably 100 or 200 basis points higher. Office exposure, to be perfectly transparent, is going to be hard to move away from. We have significant office exposure in our core funds, and we have a number of allocators that will continue to invest in office. I am definitely not going out looking for office-specific funds to continue to grow that exposure. And my hope is, through time, vis-a-vis seeking to grow our industrial, our cold storage, our medical office, our self-storage, our multifamily exposure, that we will really start chipping away at that office exposure and bring it down through time. Office exposure is the single largest property type. It is the single largest exposure in all of the core funds in the open-ended core diversified equity benchmark index. And it's high from my perspective, and I'm desperately, it will take time, but I'm definitely focused on that and not trying to grow it by any means. But because of our core exposure, largely, that's why it's as high as it is.
Thank you.
Okay, Ethan.
Okay, so assuming it's a portfolio fit, they pass that sort of secondary screen with terms and performance at a high level, then we dive in. We set up a call with the GP. We sort of hear their story, if you will. I get a sense of just how they tell the story, how they answer my questions. You know, a lot of this, I got to be honest, it's very human to human contact, gut feel, personal assessment of the complexion of the human condition is what I refer to it as. People are very dynamic and they're incentivized in different ways, and it's hard to predict human behavior. So I'm really spending a lot of time focusing on the people and how they react and how they answer questions, or how, you know, they might not answer a question, for example. So assuming that initial phone call goes well, we'll invite them to, well, actually, before we invite them to Helena, we'll send out what we call Part A of our due diligence questionnaire, which is modeled after the ILPA due diligence questionnaire. But to, I believe, Representative Walsh's earlier question, forgive me if I'm mistaken in that regard, that Part A is fairly exhaustive. It goes through about 35 questions, if I'm not mistaken. And a couple of those are very specific and set up to then kill the deal if they answer the questions in a certain way. One of those questions happens to be, you know, are you willing to forego any future, you know, political contributions to state, local, federal representatives in the state of Montana, for example? Are you willing to fill out the ILPA quarterly performance template on our behalf, for example? Are you willing to be share with us your side letters, which are agreements in addition to the limited partnership agreement that we ultimately execute? Are you willing to be 100% transparent with all of your side letter agreements with all of your investors, irrespective of what size they are or what other sorts of deals, economic or business, you've made with them? Those three are not exhaustive, but critically important. Again, to this human condition and relationship aspect, I make every attempt very early on to be as efficient with my time and be respectful of the investment manager's time. And I demand transparency. If a GP is unwilling to be transparent with us, and I apologize, I use investment manager and GP, general partner, interchangeably. If they're unwilling to share and be uber transparent, that's an automatic deal killer. If they're unwilling to stop political contributions, that's an automatic deal killer. If they're unwilling to meet our specific customized, reporting requests, automatic deal killer. And so there's, a fair amount of time spent upfront doing that. Assuming all that goes well, then we invite them to Helena and we sit down and we break bread with them in the conference room, and John's invited to that meeting. So, John understands that I've already done some initial assessment, and I think there might be an opportunity here, but then, they have a second shot on goal and John's got the ability to sort of assess them as well. And he participates in that part, of the process. After that meeting, assuming that continues to go well and all things are pointing towards the goal line, we will submit a much more comprehensive due diligence questionnaire, which oftentimes when we receive it back is anywhere from 50 to 100 plus pages of responses, which cover things like the firm, the history, the assets under management, performance in a more detailed way, the strategy, their process, their philosophy, their risk management and compliance functions, their valuation process, their approach to ESG, et cetera. It's very comprehensive. We also ask them for all of their cash flows from previous funds. We ask them for tons of performance data, which I alluded to earlier when addressing one of Mark's earlier questions. We will engage in reference calls, both on and off list. We build out 2 primary deliverables, which I ultimately present to the cabinet, which we refer to as the GP and fund profile, which are essentially a synthesized form of the due diligence questionnaires. And assuming all that goes well, we'll continue to proceed, and we'll ultimately find ourselves on an airplane and visiting the general partner, the investment manager, in their headquarters, during which time we really seek to meet as many folks as possible at the firm. In many cases, the entire firm might be 15 people, and so we can really probably meet them all. their HR director, their COO, their CCO, all the managing partners and principals. We can meet with their vice presidents, their junior analysts, everybody throughout the organization. And that's really an attempt to just to meet the people and to assess the culture of the firm. Are we still sort of aligned, or is everybody speaking the same language? Are there any inconsistencies? I'm not trying to back people into a corner or catch them in lies. I'm really just trying to have off the cuff conversations with them, get to know them, who they are, what their background is, why they're at this firm, what brought them to this firm, why they stay at the firm. So that's pretty exhaustive, and it's a good opportunity. Like I said, you can't do that with all firms. I mean, some of the GPs we invest with have hundreds of people, and you just can't do that. But you certainly meet with the key people, all the C-suite, and really assess as best you can the operating environment and the culture of the firm. Any questions on screening and diligence? I know I covered a lot, but happy to dive in further on any of these points.
When you meet and you talk to those people, how do you know you're not just getting a sales job?
I love that question, Carl. In many respects, you are. You certainly are. There's no doubt about it. I mean, their singular focus is to win you over, such that you get they hope to make you comfortable to a point where you're going to make a multi-million-dollar investment with them, from which they're going to draw fees to pay themselves and their staff, and ultimately and hopefully generate profits and take a portion of that. Again, I got to tell you, that's the complexity of what we do. And I don't expect that I'm going to bat 1,000 and I'm going to get every decision right. There are going to be things along the way that you just simply cannot underwrite, and you cannot assess how someone's going to behave in some future world. But you make every attempt to do that. And a large part of that is by meeting with these folks and looking them in the eye and shaking their hand and meeting as much of the organization as possible, all the way through the junior ranks, to assess if what you heard from the managing principal is the same thing that your junior analyst that you're interviewing is telling you. The consistency of the story, it's super important. Really, are they speaking the same language? But am I going to be able to tell you with absolute certainty that this is going to work out and this is going to be, a great accretive performing investment after all the things I've gone through, after all the data I've analyzed, after all the reading and research and people I've met? I can't tell you that. I can't tell you that, because people will ultimately do things that are confounding to me, that I could have never predicted. I hesitate to raise the issue, but we talked to you 8 or 9 months ago about BKM and what happened there with that general partner. And could I have told you 3 years before, when Emily and I were underwriting that deal, and after we had met with most of the firm and after we got absolute comfort there, that something like that was going to happen? I couldn't have told you that. But guess what? It did happen. And it's unfortunate, but that's the way it goes.
Well, I think part of the answer to my question is also that you've been doing this for a while and you're good at detecting that stuff.
I mean, sure, that is true. That is true. I've been doing it for a while, but I'm not one to toot my own horn, and I appreciate the confidence that Dan and John and the board's put in me. I hold myself to a very high bar, and I am very critical of our of the decisions we make. And at the end of the day, I mean, if we want to dive in deeper, one of the very last parts of my decision tree is am I comfortable with this investment? After all, I am putting my own money into it, vis-a-vis my ownership in the pension fund. And If the answer to that question is no, and that decision, that branch on the decision tree frankly exists throughout the entire decision matrix, I have no loyalty to a deal. I will walk in a heartbeat. This is such a commoditized business. There are hundreds and thousands of similarly situated general partners and investment managers that are lined up, ready and willing to take a meeting with us. And if at any point in a process, I just don't feel right about it, I will walk. And I am not afraid to walk. I have no loyalty to a deal. And that includes even our existing high conviction GPs. If we're reevaluating a re-up investment or commitment to an existing manager, and by the way, we run the whole process soup to nuts from beginning to end. We make no shortcuts. Even if we've invested in 5 or 6 of their funds prior, we soup to nuts, beginning to end, run the exact same process. And if we've had a relationship with them for 10 or 15 years, 5, 6 funds, and something just doesn't feel right, we'll walk. It's as simple as that.
Thank you, Ethan.
You bet. So moving on, once the diligence and screening and sourcing has wrapped up, and assuming all things have continued to point to yes, we'll gather the folks. We'll sit down with the director of risk, director of ops, all the investment directors, Dan and John, and I will sit down and I will present to them the investment opportunity. I will deliver to them the GP profile and the fund profile I mentioned earlier. And it will be a very short presentation on my behalf, assuming that everyone read the materials. And then it's just an opportunity to ask questions, poke holes, be critical of my process, and see where it goes from there. Sometimes it ends in, hey, here's some questions I want answers to before we make the final decision. Or it ends in a no, not comfortable, we need to move on. Or yes, we're comfortable, this is how we should think about sizing. That's where John comes in. As he mentioned earlier, Dan Zarling also has a role in that, being our compliance director. And we'll go ahead and approve, assuming we approve the deal. That takes us to the next phase where if we skip to page 18, and I apologize, this should have been part of the kind of legal review. It should have said sort of legal review / background checks. Once we approve a deal, we will approve certain background checks on the key members of the strategy. Usually that's the folks that are named in the key man provision, the founders of the firm, et cetera. We'll run some background checks, make sure that that those are, without their red flags, without any concerns. No legal issues, no, sort of standard deal killers. And then assuming background checks are clear, we'll proceed to legal. That entails us providing all the legal closing docs, the subscription agreements, the legal agreements, the private placement memorandums, et cetera, to our external legal counsel, DLA Piper. They'll review, they'll provide us with some comment summary on all the key terms of the operating agreement, whether it's a limited partnership agreement or a limited liability corporation agreement. We'll review that with them. We'll then go back, take our comments, their comments. We'll go back to the GP. We'll negotiate where we can. That's both business, commercial, and economic terms. Sometimes we have leverage, sometimes we don't. But really, we're focused on, are these terms reasonable, commercial, middle of the fairway, or is this an overreach by the GP? To the extent it's an overreach, that's where I'll focus my time as far as negotiating and trying to change those terms. And here again, make no bones about it, like if they are unwilling to change or morph terms into a more LP friendly construct, happy to walk away from a deal. It's not personal, it's just business. And if in my years of experience coupled with advice from counsel, what they're asking for and whatever provision is outside the lines of what's expected from an institutional perspective, we'll kill the deal. Done it before. I'm sorry?
Can you hang on for just a minute? John wanted to.
Yeah, sure. Pardon me. Please.
I'd chime in that I mentioned yesterday, so Bell Partners, the one that we showed you yesterday, I've got the GP profile and the fund profile here if you want to see the summary documents that we get, which are pretty extensive in and of themselves. That helps us make the decision as the cabinet, whether or not to approve Ethan's deal. But I think that gives you maybe a flavor for all the different things that we're looking at.
Okay.
How long are these cabinet meetings with Ethan?
I would say it's usually no more than an hour. Most of the time. It's honestly, by the time we get to cabinet, Ethan and I have had a number of discussions about it. I mean, it hopefully should be pretty buttoned up, as he said, more often than not, it's going to be, maybe we've still got a few questions that we want answered prior, but probably pretty good by that point. It probably gets killed somewhere further up the chain before it ever gets to cabinet, if that's the case most of the time.
If there's an ESG or some concern, we're talking about that up front. If there's a, usually the value add of cabinet from my perspective is you get a lot of different eyes from different perspectives. So Ethan and Michael and Thomas in particular chiming in on each other's funds is really helpful for all of us.
Okay, moving on, Ethan.
Okay, well, assuming legal review goes well, we sign the deal. We then review side letters, MFN provisions whereby we select other terms that were given to other investors. We'll build that into our overall agreement. We then transition the fund into monitoring mode, both internal and external. And we continue to review quarterly reports. We attend annual general meetings with the GP and other investors. So we get to meet the broader investor group that's in the same fund as us. We attend limited partner advisory committee meetings. We sit on a number of those committees for each each investment. We meet with the GPs to the extent they're in, or we're traveling and we happen to be in their market. We'll go meet with them in the regional offices or their headquarters. They come to Helena typically annually, sometimes more than that. And we'll also tour properties. We map out all of our individual property holdings on an annual basis. We kind of go through that exercise and we upload all the physical addresses into Google Earth such that we can go see properties when we happen to be in market, assuming we have the time to do so. And off we go. Any other questions about process? Hearing none, we can go right to slide 21, where we talk about our strategy and our rationale. And,
Sorry, Ethan. This is probably not for you, but maybe for John or Dan. With all this stuff, I'm worried about our staffing and morale and people overworking and things. And so from a high level on management, the board could be understanding of how our staffing is and how you feel do we have enough people to do these processes?
So I think when we look at our resources, the priority for the last few years was to get additional assistance into the fixed income team because we were running over $10 billion with 3 people. And that's where we put our focus. That's where we readjusted some of the other FTE within the organization into that spot. I think John and I are both of the opinion that if we get additional FTE or are able to create additional FTE by, again, reshuffling positions, we would put it into the private space. How that would fit and what it would look like, don't really know. That would be a TBD, but your strategic asset allocation that you've given us continues to ramp up on privates, given our good funded ratios and improving ratios within the pension funds. So we have that illiquidity opportunity to ramp up there, getting better returns over the longer haul. So don't know what that would look like now, but certainly as we look at the other opportunities that are going to be presented to us potentially over the course of the next year with another $2 billion in assets under management, that will become a bigger conversation. So I guess what we'd say is for the time being, we are where we are. We know we got to hire an additional analyst into the private space sometime this year. But if we are able to make additional FTE, we will put it into the private space next. So what did I miss?
You nailed it.
That's a taped, right?
Okay.
It does. I mean, one of the things I think we need to monitor is morale and, some of the other things, and Dan addressed that, so I feel comfortable with that right now.
And workflow and.
Morale wise, that's.
He
certainly-
looks happy, Ethan.
I mean, he's on a beach.
Yeah, he's on the
He's
beach.
teleworking from the Maldives, so. I think from a morale perspective, it's kind of hard to gauge where we're at right now as we're just getting sort of back into the normal workflow. I mean, certainly the coffee maker helped, but huge. But I think from a morale perspective, we'll focus on folks that are here and making sure that we're all keeping track, the management team's keeping track of their team and reporting problems to me. I'll make you aware if there's sort of if there's a morale problem that needs to be addressed, we'll do everything we can to address it. Certainly the PGP helped, that we now have a career path for our employees, that they're able to move on. We've been promoting internally as opposed to doing heavy recruitment externally with a lot of paper and degrees. So there's upward mobility within the organization like there hasn't been, but there's also compensation strategies wrapped around that as well.
Okay, well, let's let Ethan finish up here in the last few minutes.
Okay, so strategy and rationale. This is frankly no different than what we've talked about over the last handful of years in the quarterly reviews. The focus is on the US, but we look at everything. We prefer the vertically integrated operators for reasons I've listed next door. We're continuing to grow real estate debt, as I mentioned earlier, reduce core, also mentioned earlier, continue to focus on our high conviction GPs. Again, feel like the portfolio is in really good shape. So as far as what's happening on a go forward basis, it's very specifically targeted, looking to grow medical office, looking to grow industrial, looking to grow multifamily. Hopefully someday I can find the right self-storage operator. Separate accounts, as I've mentioned, these are long duration holds, income focused, almost in a position where I can really focus on that. COVID kind of delayed that a little bit, but towards the end of this year, we'll re-engage and actually have a couple meetings scheduled to talk with some of our current operators, one new one that may be potential separate account candidates, and then always looking to tactically add to the public REIT exposure and grow it when the valuations are right. Happy to address any specific whats or whys. Okay, well, if none, then finally, as I mentioned earlier, we do on an annual basis, we get the physical addresses of all of our current holdings and we map them out on Google Earth. And so as we've done historically, let's take a couple of property tours. I've listed 3 here. These are all with some of our operators, one multifamily with Bell, one medical office with Hammonds Partners, and another a retail property with the Sterling organization. And I will turn it over to, I believe, well, whoever's running the show, please, let's launch into the Bell property tour if we have time.
I was going to show them the picture first of the
Sure.
All the properties.
Yeah, yeah.
So this just shows what we own, where we own it very broadly. Just you can see that it's diversified. Yeah, Ethan, I forget what the colors of the dots mean.
Yeah, I haven't committed those to memory, but I was going to share the one data point. we have exposure to over 1,000 individual holdings across the globe. Frankly, we've got holdings in Europe, holdings in Asia, predominantly here in North America, but pretty diversified portfolio across all four property, well, more than four property types.
You want to do Bell first, Ethan?
Yeah, sure. Let's dive into Bell.
Hold on a sec. Share thing.
When Ethan's on a beach and not in a warehouse, it makes me nervous.
Not in a self-storage unit.
So what we're seeing here, we're zooming into Bell Capitol Hill. This is a multifamily asset owned and operated by Bell Apartments, Bell Partners. We hold it in our Fund 7. It was acquired in 2016, built in 2013. As we zoom in, you can see a metro stop not too nearby. We're right off Capitol Hill, or sorry, nearby, pardon me, not too far away. It's 141 units, not too far away from RFK Stadium. It's directly across the street from a high school. The property features a fitness center, a business center, rooftop deck. It's constructed with a 2-level concrete parking garage. It's full of young professionals working in Capitol Hill. As I mentioned, it's near a DC Metro system. Purchased it for $47 million, currently valued at $55 million as of 3/31/21. But nice example of a Bell quality property. Any questions? Kind of a neat tool, I gotta say. I mean, it's a great exercise to go through. If we just happen to be in a market, we can just swing by these things ad hoc with no sort of advisement, meet with the local property manager in the office, leasing agent, et cetera, ask questions, assess the property, make sure there aren't weeds growing around or, you know, anything's in disrepair. It's a nice tool to have. Next up is Hamas Partners 3. They're our medical office operator. This is a Salt Lake City owned asset. It's 96% leased. It was acquired in 2020. It's a 34,000 square foot building. Excuse me. It's not too far off of I-15, so pretty good ingress and egress. It's anchored by one of the largest healthcare systems in Utah, which also operates an adjacent acute care hospital. In this particular property, offers a diverse mix of services, including pediatrics, physical therapy, urology, and women's health. And a relatively full parking lot, which is what we like to see. But what we really like to see is high occupancy with a credit tenant that's paying their rent. And they're able to pay the rent because of all the patients they see. Good looking asset. Excuse me.
All right.
We're going to stop it there, Ethan.
Yep.
I'm sorry?
We're going to stop there if that's all right.
That's fine with me. You guys are in charge. So if there are no questions, thank you very much for the time. Happy to follow up on anything. Just let me know and I'll be, excuse me, seeing you later this afternoon.
We will be seeing you later this afternoon and we can ask.
Okay. Thanks, everyone. Really appreciate the questions.
Yeah. Anything else from anybody? All right. Thank you, Ethan. Enjoy the beach.
Thank you. I'm off.
All right. We've got a break scheduled till 11:15. Let's take it. We're missing.
Dan, a few people.
There we go. There they are. All right. Oh, Mark's at the beach too.
Oh, Mark, got a new picture.
You don't wear a tie at the beach.
Are we back on the record?
We're back live. Mark, we can't hear you. I don't know if you're, look like you're on mute, so.
Now you're frozen, you know?
Can you hear me now?
Oh,
There
yep.
we go.
Okay, sometimes I have to switch the microphone. Sorry about that.
Mark is wearing a tie at the beach.
I am. You know,
All
I've
right.
been told that I'm leaning back on my chair, so this is kind of an incentive not to lean back, you know, create a little fake fear.
All right, so we are behind tab 8, or we are behind tab 9. And RVK, which is a 2020 Greenwich Quality Leader. So who's up there, folks?
I think, Carl, I'll start if that's okay. And yes, we are very proud of that. We're not going to toot our own horn, but we did want to let people know that there's no other firm that has won this award 4 years running, and we have. So it speaks well to the staff that Becky has built over the last, what, Becky, 25 years? So
More than that.
we won't go any further than that.